This is what value investing is like, finding hidden gems that the crowd has overlooked. Take the example of Warren Buffett, one of the most successful investors of all time. Buffett's strategy revolves around identifying high-quality companies and holding on to them for the long haul. He famously invested in companies like Coca-Cola, American Express, and Apple, not because they were hot stocks at the moment, but because he believed in their long-term potential and competitive advantages. He was interested in steady, sustainable growth over decades. By focusing on long-term, value-driven investments, you're letting time work in your favor, instead of trying to time the market or predict short-term price movements. You're betting on the long-term success of solid businesses. This approach minimizes risk by avoiding the emotional ups and downs of the market and maximizes the power of compounding returns. For instance, consider the example of investing in Johnson & Johnson, a company with a long history of steady growth and strong fundamentals. Even during market downturns, Johnson & Johnson has demonstrated resilience due to its diversified product lines and consistent demand in the healthcare sector. An investor who bought Johnson & Johnson stock years ago and held onto it in the short-term noise would have seen substantial growth and regular dividends over time. This is the power of focusing on value and long-term potential rather than chasing after what's hot in the moment. One of the biggest mistakes many investors make is over-relying on high-risk, high-reward strategies. The allure is undeniable. Placing all your money into a single speculative stock with the potential to shoot to the moon can feel like a shortcut to wealth. The thrill of a massive payoff from a single bold bet is enticing, but the harsh reality is that this approach is more akin to gambling than it is to sound investing. While you might occasionally get lucky and score a significant win, the odds are far more likely to lead you to significant losses. When your strategy is built on luck instead of sound financial principles, you're essentially playing a game with bad odds. The stock market is naturally volatile, and speculative stocks amplify this risk even further. You could see dramatic price swings that wipe out your gains and more, especially if you aren't prepared to handle these fluctuations.